Monday, March 27th, 2023, Monaco 64, home of alternative economics and contrarian views. Today we're going to look at an editorial from the FT from almost 20 years ago now. That's how fast time goes by. And I've spoken about it quite a few times. The old subscribers, old viewers, most probably will remember it. Some of you will say, why are you looking at this again? Well, because I think it's important for the new viewers and subscribers to realize that a lot that we're told by the mainstream press, be it business and financial press or any other press, is a lot of propaganda. And I learned that back then. And it's this editorial here, as a lot of you know, going gold, the pointlessness of holding bullion continues to sink in. Yes, they wrote this back in 2004, the FT. So we're going to look at that today. Yeah, Rudy is here with me. There you go. He's fairly quiet. He was asleep in his bed earlier. His bed is behind me on the floor, but he wanted to come up. Hopefully he'll behave. He'll stay here with me. Yes, he hasn't grown up enough to stay on the sofa all the time like Billy used to. Before I start today, I'd like to give a shout out to Swift Refunds. They contacted me a few months ago. What they do, it's a UK-based company. They help mobile workers in the UK claim back tax that they could be owed for expenses. A lot of people don't know that they could claim tax back for being a mobile worker. So all the details of what you need to do are below in the description of this video. If you're not a mobile worker, if you are in the UK and you know someone that is a mobile worker, someone that has to move around for his or her job, let them know about my link, Swift Refunds / Monaco 64. So before we go into this editorial, I want to look at a quote from Sun Tzu, Chinese philosopher, about knowing your enemies. And this is what this is all about, the FT. And I subscribe to the FT, of course. It says, if you know the enemy and know yourself, you need not fear the result of 100 battles. If you know yourself but not the enemy, for every victory gained, you will also suffer a defeat. If you know neither the enemy nor yourself, you will succumb in every battle. So a lot of you know that I worked in the city of London in the financial sector for 20 years. Started in London in 1992. I started working for a small private bank, of course, in late 1989 in Geneva, Switzerland. And the bulk of the business we did were in bonds, even though we did other things. So I've always focused on the bond markets. And in I was a futures and options broker. I worked for brokerage houses, for banks, and my clients were institutional clients. So in the beginning, in let's say the first 10 years, maybe a little less, yeah, I did my job. Looked at the fundamentals of the markets, of the economy, looked at some of a technical analysis, of course, of the markets. That's something I like to do a lot. Some people were only technicians, not fundamentals, but I thought it was good to have both look at both. And then I started looking into other things. The more successful I became in my job and in my career, the more tax I paid. And I thought to myself, why is so much of my what I earned going to the government? And I started looking into free markets, the Austrian School of Economics, into sound money, and I started questioning things. And after the dot-com bubble burst, I started questioning it even more. I started reading a lot of the Mises Institute blog articles. I started reading LewRockwell.com, libertarian, small government leaning website. And I started looking into gold and silver, of course. I had read Atlas Shrugged as well in the late 90s. That changed the way I thought a lot. And so by 2004, when this came out, and I'm going to pause this. You can pause this, sorry. I'm going to put like a copy that I have, a file, so you can read it. But I'm going to read it to you as well. So the story about this editorial, and I even cut it off the FT and had it laminated. At the time I worked for MF Global, which actually was Men Financial at the time. MF Global was only IPO'd in 2007. It was a spin-off from Men Financial. And I had it laminated in the office because I thought, well, how can they say this about gold? And at the time, I even marked that gold was at $400 an ounce. It was April 16th, as you can see here. So knowing what I knew already about gold back in 2004, I could tell that this was a hit piece. It was pure propaganda. It was not like objective, looking at gold as a sound monetary asset that it has been for thousands of years. And that's why all the alarms went off for me as far as the FT is concerned. And it's still the same for me today. I read the FT and look at articles and show you articles in the FT, but I take it with a huge chunk of salt. They always have an agenda, the globalist central bank agenda. So let's go through this, and you realize that all the reasons they gave back then, they're all been like trampled upon the Keynesian central banking experiment that they thought was going to go well forever. So let's start. The Barbarous Relic, as Keynes called it, is crumbling to dust. When even the venerable N.M. Rothschild has quit the gold market, and the Bank of France, amongst the most stubborn of the official gold bugs, is thinking again about its bullion holdings. The end of gold as an investment has come a little closer. It will not be before time. The fetishization of shiny yellow metal decades after it ceased to be used as an anchor of the international monetary system is a lingering anomaly in modern financial markets. Perhaps Rothschild's last service to bullion, to the bullion market, could be to keep a live gold trader on display behind glass as a reminder of a bygone age, like the former coal miners who now make a living giving tours of defunct pits. Well, tell that to all the major central banks around the world that have been buying gold hand over fist in the last few years. The one advantage of gold as a reserve asset is that, unlike assets based on fiat money, governments cannot make it worthless by inflating it away. That's right, FT. This is the interesting part. But in an era of low inflation, and given the independent inflation targeting central banks are the norm across the industrialized world, that risk has very sharply diminished. The other thing that I was prepared for is not to buy into this era of low inflation, because I've always told the viewers, inflation is not the CPI. That's a tinkered statistic on prices. Inflation is the creation of money and or currency and credit out of thin air. It's the deficit spending by governments. Only governments and central banks can create inflation. So I knew back then that this was a farce, and it has proven to be a farce, albeit about 18 years later, 2004 to 2022, we started seeing prices really rising, but I knew we had inflation as well. It was reflected in the price of financial assets. It was reflected in the fact that bond yields went negative, which is a crazy thing that doesn't make sense. It's totally unnatural. So let's continue. Indeed, for both private and official investors, gold is now a rather risky asset with a nil or low return. The intrinsic value of gold, determined by its use in various industrial processes, is well below its market price. Gold does not grow, so its value to any one investor as an asset is dependent on other investors also holding it as an investment asset. The gold price hangs precariously by its own bootstraps. So yes, gold, of course, is money. Unless you lend it, you don't get any return. That's the whole point of money. It's supposed to be safe. What we have today, fiat currency, is not money, it's credit, as JP Morgan said. And one thing I've always thought about this little editorial is how many people or investors or funds did this thing put off from buying gold. Because if you look at the record of gold in all major fiat currencies since 2002 to 2022, the average return has been around 9% annually. For some currencies, it's been even more, like in sterling. For private investors to hold gold on this basis is their own foolish affair. For central banks and government to hold it as a reserve asset is a betrayal of the public on whose behalf they are acting. Despite recent sell-offs, governments and central banks still hold about a fifth of the world's bullion. Their large holdings relative to the size of the market by themselves make gold particularly ineffective as a reserve asset. The very act of official selling of bullion on any large scale to raise cash will itself drive down the price. The danger was amply demonstrated by the UK's unhappy experience of trying to sell some of its gold holdings, pre-announced in 1999 in a sensibly open and transparent fashion. Well, in markets, you don't pre-announce. It's not sensible to pre-announce that you're going to sell or buy something, because you're going to get the front runners. Announced in 1990, so the sales sparked such a fall in the global bullion price that a group of central banks signed a concord limiting such sales. That has recently been superseded by a new arrangement providing for limited official sales. Well, that's Gordon Brown, right? And the rumor that we heard in the city and the gold market is that the reason he pre-announced that sensibly was that there were a few bullion banks that were in trouble, that they had a huge short position they couldn't get out of. So what's the best thing to do to get out of it? Well, have someone like Gordon Brown pre-announce it. And I wouldn't put it past Goldman Sachs being one of these bullion banks back then. Because Gordon Brown, one of his major economic advisors, by a guy by the name of Gavin Davies, I think, he was a partner at Goldman Sachs. Goldman Sachs was just about to go public, and it could have been that the reason why he pre-announced that to help the city of London, to help Goldman Sachs. And what that did as well, it helped Gordon Brown be able to come out with his spending, tax and spend programs in the next few years, and with no criticism from the city of London, or at least banks like Goldman Sachs were behind the Labour government, and that led to a huge housing bubble, of course, that ended in tears in 2008. So I think it's all related, to be honest. So here's the kicker. The conclusion. Given the pointlessness of holding gold, the speed of its official sell-off scarcely matters unless leaching the gold into the market bit by bit somehow maximizes the return to the public purse by limiting the impact on the price. That would imply some irrationality on the part of the market, but then holding gold is irrational in the first place. Perhaps the central banks are right to go slowly. Whatever the speed, the direction is clear. Gold is on its way out as an investment and as a reserve asset. 3 cheers for that. So I'll tell you the story of the first time I read this. I used to get up very early to go to work in the city. I had to be at my desk by 7 a.m. So I used to get up at 5, get ready. I used to go and walk Billy the First. At the time, yeah, we had Billy the First. He was born in 1995. He died in 2008. So I used to walk him probably around 5:30 in the morning, and then maybe have a little bit of coffee and get ready and walk to the station. I lived only about 5-10, well, just over 5 minutes from the train station. I used to get there maybe 10 minutes before the train left, around 6:08. And I used to buy the FT back in 2004. There weren't really smartphones. You didn't have apps to read things. So, and I used to like turning to the editorial comment section first. And I saw this, and I was on the platform waiting for the train, and I read this basically before the train arrived, and I was like, I was kind of angry, but then I laughed at it, and I thought, I need to keep this. And by then, of course, I had started stacking not just gold, but also silver. So that's the story, and that's why you can't really trust the FT. You can't really trust the Wall Street Journal. Yes, because they're in bed with the big banks. They're in bed with the central banks and the governments, and yeah, they're gonna try to discourage you from having real money, because that's what gold and silver aren't. So with that, let's quickly look at where the markets are this morning. It's 8:33 a.m. London time. We've got spot gold at 1967. It's down just over $10. So yeah, gold is still, I think it's still doing okay. Technically, I think it's broken out of a new neckline. There's a neckline that we broke out back in December from, and it went almost straight to that 1960 level and then corrected. And now the neckline is around 1950, 1970, right around here. And I think we've broken out of it. And my target for the next few months, believe it or not, is around 2,300 for the dollar price of gold. So I'm not concerned. And I usually don't look too much at the technicals because I think we need to look at gold and silver as more of a long-term holdings for the safety of your assets, monetary assets. But be as it may, if some of you are there trading paper gold, I'm not giving you advice here, but this is what I think. Gold is looking pretty good. Silver is down about 23 cents. It's testing that 23 level. I think silver looks good as well. I've got a trend line in silver coming in just above 24. I think if we break through that area, it could be very, very bullish, even more bullish than silver has been. So let's look at where the stock market indices are. We got the Dow futures up 62 points, so it's up about 0.2. The NASDAQ 100 futures down about 30 points, or 0.25%. S&P 500 is up 4 points. To the currencies, sterling is up slightly, 122.43. The euro is unchanged, 107.61. The dollar is up 1/3% versus the yen, 131.16. And the dollar is up slightly versus the yuan at 688.15. What about Deutsche Bank? How's Deutsche Bank doing today? There's a lot of speculation how it would open this week. Well, it's up about 3%. It was down over 8% on Friday, but it's nowhere close to being out of the woods, I would say. It's the old saying of the dead cat bounce. To the other currencies here, we've got the Aussie dollar unchanged, 66.50. We got the dollar down 1/8% versus the Canadian dollar, 137.27. And the Kiwi dollar is unchanged, trading just below 62. To the general commodities, let's look at platinum first. It's trading at 972. That's down $10. We've got WTI crude up almost 1%, just below 70, and Brent crude is up 0.75% at 75.15. High grade copper down 0.5% at 405. To finish off, let's look at the U.S. Treasury yield curve. We've got the 2-year note yield up 11 basis points at 389, so that's up quite a bit overnight. And the 10-year is up 3 basis points at 340. So it's still heavily inverted, the yield curve. With that, Rudy, there he is. He slept right through. Well-behaved Rudy. We're going to wish you all a very good day. Take care. Bye.